Now, most of the countries, including all major economies, are negotiating a global overhaul of the cross-border taxation of MNCs. Now, reports say major economies have backed plans for this new rule, where companies are taxed at a rate of at least 15%. OECD, which is Organization of Economic Cooperation and Development, which hosted talks, said a global minimum corporate income tax of at least 15% could yield around $150 billion in additional global tax revenues annually. OECD also said 130 countries representing more than 90% of global GDP had backed agreement at the talks. These countries include Switzerland, India, China and France. However, there are many small nations who are not in favor of 15% minimum corporate tax, including low-tax EU members like Estonia, Hungary, while other nations opposing deal include Peru, Sri Lanka, Nigeria and Kenya. New rules on where the biggest MNCs are taxed at least 15% would shift taxing rights on more than $100 billion of profits to the countries where profits are earned. The minimum corporate tax does not require countries to set their rates at the agreed floor, but gives other countries the right to apply a top-up levy to minimum on companies' income coming from a country that has a lower rate. The group of 7 advanced economies agreed in June on a minimum tax rate of at least 15%. The broader agreement will go to a group of 20 major economies known as G20 for political endorsement at a meeting in Venice next week. WION now available in your country. Download the app and get all the news on the move.